It is Saturday, 9/18/21, and today I'm going to talk about selling covered calls and what I'm doing with that, and especially with the stocks I'm particularly selling covered calls on. Right now, I'm selling covered calls on Skillz, on the dip on Skillz. As you can see, this last week, Skillz is down about 2%, and over the last month, it's been up about 4.68%, but over the last 3 months, it's been on a downtrend about 41.88%. And I started buying Skillz a couple weeks ago to sell covered calls, and it's gone down slightly. This week, I added another 100 shares, bringing my average cost down to $11.59. I've got 2 contracts open, expiring this week, worth about 18 cents. I pulled in about 25 cents of premium when I sold that, so that was a good 25 cents divided by 10.99, which is the price now, about 2% times 100. So yeah, about 2% premium per week is what you're getting, and that's above the current strike price. But what I want to talk about is Skillz also doesn't have a high margin requirement, so it's got a 50% margin requirement. Means to buy a share 100 shares right now at $10.99, or let's say $11, it costs you $550 with the margin. So really, you're making 4 to 5% at that strike price, and at the money right now, you would be making 4.46 times 2. You've been making almost 9% with your margin. As long as it doesn't slide below that 35% maintenance, you'll be good. And the reason I picked this stock to sell covered calls on is because of that high premium coming in, and because I think it's gonna reach a point of stability pretty soon. As you can see, it's kind of been up and down since May, from around as high as 25 to as low as right now, 10, 12. But you can see it's kind of got some stability, and that's what you want. You don't want to sell your covered call and then the price go down. You might give up a little bit of premium just to have more stable. I don't think there's too much downside left. So as I average down, I could be patient and wait for it to come back up to the break-even point. That's kind of where I'm selling the covered calls, at the break-even. I might add another 100 shares going forward. But the reason why this has a lot of support at this level is because this was a recommendation from the Motley Fool. And whenever the Motley Fool makes recommendations, they kind of stick to them and kind of tell you, buy the dips or whatever. So all their members and all the people that follow their website, that are bought into this, might be buying the dip as well, giving it slightly more, support levels at this particular price. And if we look at the articles coming out, Skillz stock is taking off. Is it a buy right now? And then it goes through saying this is a mobile app company trading for around $11 a piece, blah, blah, blah. Skillz has a potential short squeeze candidate. I think if we look over here, the short squeeze on Skillz, it's got 22.17% short. So this is going to come back up if people start buying it. It's got a price target of $18. So yeah, this is not a long-term investment for me, because right now they're not making any money. As you see, there's no earnings. The price to sales ratio is 15.17, which is decent for a growth stock. The thing that I like about them is that they don't really have any debt. As you can see, there's no debt, but that's probably because they're watering down their shares. They're issuing shares rather than taking on loans and stuff. But the quick ratio at 5.7, the current ratio at 5.7, so means they got 5.7 times more assets than liabilities. But they don't really got any long-term debt to hold them down. And as you can see, they're projected to grow 31.7% next year on their earnings per share, but really they don't have any earnings, so that's kind of almost a meaningless statement. But what's good about them is the gross margins are phenomenal, 94.90%. So basically, once they acquire customers, which they're paying a lot of money to acquire customers, but once those costs come back down and they have the customers, they make almost nothing to keep them, or actually they make nothing on their actual services to have additional customers. So it's not like you're selling a product and you gotta buy the product. Since it's all digital, replicating it doesn't cost them any additional money, so their gross margins are phenomenal on their products. And basically what they do is they make mobile game apps where you could bet on, and based on your skills you could bet, I guess, other players, and whoever wins takes the money or whatever. I hear it's quite addicting. They don't have any super hit games out yet, but they have a good business model. Overall, they're strong. It's just they're good to sell covered calls on right now because the volatility is relatively high, giving you a 4.5% at the money. And if you could wait out the drawdowns and just average down and sell, you go back to the account, you could see your average price you pay for it. I mean, the first 100 shares I bought at maybe $12.25 or $12.50. I bought another 100 shares this week to water it down or average it down more. And if it drops more, if it drops to $10, I'll buy another 100 shares and sell cover calls at whatever average cost it would be, like around $11, whatever. And I'll keep doing that for a month or two. And then if it keeps dropping, I'll kind of reconfigure and try to only take in premiums that break even at that point, so I could keep the percentage I made up to that point, which is kind of confusing when I say it. But what I mean by that, see, my average cost is $11.59 right now. So if I sold this at the money call, I would be losing 11 cents. But if I go 2 weeks out and I sold an at the money call, 68 cents, I'd be making 11 cents on every share I sold. So if it drops a lot, then I'll just sell to pretty much get out of it and keep the percentage of what I've already made, which at this point it's like around 8, 9, 10% of my initial investment. So that's kind of my plan with that. I've been doing similar things with Western Digital is my long-term leap options, but I've been doing similar with that. I believe it's going to come up to around $63, $65 when the earnings call comes. And if the earnings call blast earnings, then this price to earning ratio will drop to about 10. I think you'll get more new investors to push it up long term. I'm planning on keeping it as long as the earnings meet what they expect. If they don't meet what they expect, then I might have to take a hard loss. But moving forward, this is a long-term investment. The drawdown's been about 16,000 or about 35%. But with leap options, the leverage and stuff, once it gets over 65 in the 70 region, then you make a lot more money as well. So it goes both sides. Newegg is another one. I pulled in close to $300 in premium anyways, so this is kind of at break even. So if I sell at my actual share break even price, $18.46, if I sell covered calls at that and just wait for it to come back up, I'll keep that $300 of premium. Or since it's $18.50 right now, I could go out and sell an at the money covered call, for 3 weeks out, and this will get me to my break-even point plus 17 cents. And if it keeps going down, that'll protect me on the downside as well. So it's kind of a game. I'm trying to come up with a system that allows me to make, 25, 50, or even 100% a year, just kind of playing the up and downs of each stock. Since this market has been crashing a lot, Alibaba would be a good stock now because it's near their low point. They've been crashing for a while, but if you want to stay away from Chinese stocks, that's understandable as well. I'm trying to set up a position with them, but I tend to like stocks that trade in the $15 to $45 range because they can pull in decent premiums, but they won't cost you a lot. So if you end up having to average down, you can keep that in mind. So yeah, that's kind of been my strategy as I wait for my Western Digital Leap options to rebound, and when the new earnings come out, if it is around 2.50 per share, it'll go back up to $65 to $70 range, and I'll reassess if I want to keep this long term or not. If it doesn't, then that option might be in trouble. I might have to hold it for a little bit longer and sell calls against it or what to average it down. But that's kind of the risk you take when you're trying to grow your account. But like I said, it's a long term. So the hard drive industry has a annual growth rate of like 15%. So it's hard to see over the next 5 years. So that's why I was reading 11 to 15% over the next 5 years. So it's hard to see that going down. And they're in a possible merger with another Japanese company. WDC. Okay, that the possible merger with Kioxa. They're another company about the same size as Western Digital, and it seems like they're halfway between merging with Western Digital or going public. If they were Western Digital, that would send the share price to $65 to $70 range just on the news. Just on the rumor, it merged them to that range, and they want to do a $20 billion stock merger. So we'll see. Right now there's no catalyst or news, so it's just going to go weak with the market and not necessarily with the company, which is when people tend to average down, and when it makes sense to average down when there's no news or fundamentals that drop it. But I just got to be patient with that. But with Skillz and stuff, I can make some money whether it goes up or down, kind of keep that at the average the same, and never sell below the average price you pay unless you're making enough premium to make up for it. And you might have to go a few more weeks out, not the same week, maybe a month out. But that's kind of my plan. I've made already 15 to 20% on these. If I could get them back to the average, I only have enough to sell 2 covered calls, one on Western Digital and 2 on Newegg. So when those get called, then I'll put it into these other stuff, average them down, and when they get called away, find better stocks. I'm looking at Hood right now. Seems like a good stock to sell covered calls on. Robinhood seems like it's leveled out a lot. They dropped their margin requirements to 52%, 40% maintenance. So that's kind of another thing you got to look at, is if you're going to use margin, which would double your percentages based on how much money you put in. The initial requirement and the maintenance requirement. So Hood's not looking too bad. That's why Coinbase looks kind of good, but I don't have quite the money yet. But when I get the money, I'll probably sell some covered calls on this with a 50 and 25% maintenance for something, tied to a volatile Bitcoin. That's pretty good. They're at the money. Covered calls are 2.7% a week to 2.2%, so around 2.5%. And if you use margin, that's like 5% a week. So that's kind of my strategy right now. Kind of waited out on my long-term plays. Maybe when they pop back up, not leverage myself so much. I was trying to make a huge swing in my account, but we'll see. I had AMD for a long time pegged to grow, and it showed a lot of weakness before it went on its huge run, and I kind of saw the potential in AMD as a company and the stock and stuff, and I saw it down towards a support level on a gap. That's kind of how Western Digital is. What AMD was back in March, it was down. It was kept going down from like 100 to about 70, 75 range, and then it seemed to pop back up to new highs. I think the high before was like 90, 95, and then it dropped all the way to 75. Western Digital's high before was like around 70, 75, and it's dropped all the way down to 58. So just depending on how things look forward, and they've been beating all their earnings, so hopefully that's kind of the state of my account right now.